Have you ever entered a trade after a breakout only to see the market reverse and stop you out? It's frustrating, right? You think price is breaking out, but instead it's just a trap. The good news? There's a simple yet powerful strategy that helps you avoid false breakouts and enter trades with confidence. It's called the Break and Retest Strategy. In this video, you'll learn how to identify a real break and retest setup, the best entry points to avoid false moves, how to trade it in both uptrends and downtrends, the biggest mistakes traders make and how to avoid them. By the end, you'll have a clear step-by-step plan to trade, break, and retest like a pro. Before we dive in, make sure to smash that like button, subscribe for more trading strategies, and turn on notifications so you never miss an update. Let's get started. The break and retest strategy is one of the most effective ways for you to enter trades with confidence while avoiding false breakouts. Instead of jumping in as soon as price breaks a level, you wait for a confirmation retest before making your move. Here's how you do it. Price breaks above a strong resistance level, signaling potential bullish momentum. Instead of entering immediately, you wait for price to pull back and retest that same level as new support. If price rejects the level, that's your confirmation to enter a buy trade. This approach helps you avoid false breakouts that trap early entries, trade with momentum instead of against it, and enter at a better price with a stronger risk-to-reward ratio. The same concept applies in a downtrend when price breaks a support level. Before you can fully apply this strategy, you need to understand the psychology behind the break and retest strategy. When price breaks above a key resistance level, it signals that buyers are in control, pushing the market higher. Traders who entered early, before the breakout, are now in profit. But here's the catch. Markets don't move in straight lines. As price climbs, those early buyers start selling to take their profits, causing a pullback. This isn't random, it's the result of traders closing their positions, which creates selling pressure and makes the market drop. Now, if you enter right after the breakout, you risk getting trapped as price pulls back. This is where most traders go wrong. The smart money, the same buyers who took profits at the top, are now looking for a new entry at a better price. And where's the best place to buy again? The previous resistance, which is now turning into support. Once price reaches that level and rejects it, it's a strong signal that buyers are stepping back in. That's your confirmation. If you enter here, you're trading with market momentum, not against it, and applying the break and retest strategy the right way. Now that you understand why this strategy works, let's move on to the foundation that makes it all possible: market structure. To trade the break and retest strategy effectively, you need to understand market structure. This helps you spot high probability setups and avoid unnecessary risks. The market moves in 3 phases, and in each one, price reacts differently to key levels. In an uptrend, price forms higher highs and higher lows, meaning buyers are in control. But here's what's really happening. Buyers buy low at key support levels and sell high as price moves up. Each resistance level that gets broken becomes a reference point, a place where buyers might look to enter again. When price pulls back to retest a broken resistance, buyers often step in, pushing price higher. That's why, in an uptrend, you don't just buy anywhere. You wait for price to retest a former resistance and show signs of rejection before entering. In a downtrend, price moves by creating a series of lower highs and lower lows, showing that sellers are in control. Here's what's happening behind the scenes. Sellers enter positions at key resistance levels and take profits by buying back at lower prices. Each time a support level is broken, it becomes a reference point where sellers might look to re-enter the market. When price pulls back to retest a broken support, sellers often step in again, driving price lower. That's why, in a downtrend, entering too early can be risky. You wait for price to retest a former support and confirm rejection before looking for a sell. In a range, price moves between support and resistance, meaning buyers and sellers are evenly matched. Unlike trends, a breakout alone isn't enough confirmation that price will continue in that direction. A breakout can be a fake move. This is why waiting for a pullback or retest is essential. If price breaks above the range and retests the previous resistance, it signals that buyers are gaining control. Without a retest, you're gambling on a breakout rather than trading with confirmation, and that's a mistake that traps many traders. Now that you understand market structure, let's focus on how to identify a high probability retest, because not every price pullback is a trade-worthy setup. To trade the break and retest strategy the right way, you need to focus on confirmation, not just the break of a level. Here's how you do it. Look for a well-defined key level where price has reacted multiple times in the past. Weak levels that price barely respected are more likely to fail. In this example, we have a key support level. Instead of entering immediately when price breaks the level, you wait for the market to pull back. This is where smart traders position themselves. Once price returns to the broken support, your job is to observe price action. You don't enter yet. You wait for confirmation that this level is now acting as new resistance. This is the key moment. If price rejects the level with strong price action patterns like pin bars, engulfing candles, or multiple wick rejections, it signals that sellers are stepping in to push price lower. Once rejection is confirmed, you enter a sell position, placing your stop loss above the retest level for protection. The same process applies when price breaks a resistance level. After the breakout, you wait for a retest and rejection before entering a buy trade. We have seen how to trade the break and retest strategy in a trending market. Now let's focus on how to trade it in a range-bound market, where price moves between support and resistance. In a range-bound market, price bounces between support and resistance, showing no clear trend. To trade a breakout in this market, follow these steps. Wait for price to break the range. Wait for price to pull back to retest the broken level. Enter only after confirmation. Why wait for the retest? Entering immediately after the breakout can be risky because early buyers take profits, causing a pullback. The only safe entry is after price retests the broken level and rejects it. This retest ensures that price respects the breakout, increasing the probability of a successful trade. Let me show you something few traders notice. Before a breakout, the market often sweeps liquidity at the support level. Here's how it works. Liquidity exists below support because many traders place stop losses and buy orders there. The market briefly drops below support, triggering stop losses and trapping sellers. Once the liquidity is taken, price reverses sharply and breaks out in the opposite direction. Look at another example. This time, price is moving within a range-bound market until buyers break above resistance. But instead of continuing higher, price closes back inside the range. This is a clear liquidity sweep. A liquidity sweep like this signals that the range is ending and a new downtrend may be starting. But right now, nothing is guaranteed. This is just the first sign of a potential shift. If you miss the liquidity sweep trade, do not enter inside the range or after the breakout. As you can see, after taking stop losses at resistance, the market breaks below the support level, confirming sellers have taken control. But your job as a trader is not to chase the move, it's to wait for a retest. Why? Because at this point, you don't know what's going to happen next. As you can see, the market retraced back and retested the broken support level as new resistance. This happens because traders now see it as a key reference point to sell from again. Sometimes the retest happens, sometimes it doesn't, and that's okay. You need to shift your mindset about missing trades. If the price never comes back for a retest, don't see it as a lost opportunity. It just means the market is protecting your capital for a better setup. It's better to miss a trade than to enter impulsively after the breakout and lose money. Now that you understand how to trade range-bound breakouts with liquidity sweeps, let's move on to the price action patterns that confirm a strong retest entry. A retest alone is not enough. You need to see clear rejection at the key level before entering. Here are the most powerful price action patterns to look for. The first pattern to look for is called wick rejections. When price retests a key level, one of the strongest signals you can look for is wick rejections. This happens when the market attempts to break through a level but fails, leaving a long wick behind. Why do wick rejections matter? Wicks show rejection. The market tries to push beyond a level, but price snaps back, proving that buyers or sellers are defending that area. It reveals liquidity traps. Smart money often sweeps stop losses before reversing, leaving a wick as evidence of trap traders. The more wicks, the stronger the level. If price keeps testing a level but can't break through, it signals a high probability trade setup. When price breaks above a key resistance level and then pulls back to retest it as new support, a bullish pin bar can signal a strong rejection. A pin bar is a candlestick with a long lower wick and a small body, indicating that buyers are stepping in after the retest. Here's how to trade this setup correctly. You can place your entry just above the pin bar's high after it closes. This confirms that buyers are stepping in and price is likely to push higher. Set your stop loss below the wick of the pin bar. If price drops below this level, it means the setup is no longer valid. The best place to take profit is at the next key resistance level, where price is likely to face selling pressure. Besides pin bars, you can also use other candle patterns for confirmation. Tailed bars. These candles have long wicks, indicating rejection at key levels. Dojis. These are indecision candles that can signal a potential reversal, especially when they appear during a retest. The key is to wait for confirmation. When multiple wick rejections form at the same level, it strengthens the setup and increases the chances of a successful trade. Important note: what I've shown you here is how to trade the break and retest, but there's one key element you should never overlook: top-down analysis. Always start with a higher time frame analysis to ensure your trade setup aligns with the overall market structure. This helps you avoid trading against the dominant trend and increases the accuracy of your trades. If you want to learn more about top-down analysis, check out my channel. I have a detailed video that breaks down this concept step by step. Now that you understand how to trade wick rejections, let's explore another powerful price action pattern: inside bars. Look at this chart example. Price has been moving sideways within a range, showing that neither buyers nor sellers have full control. Then, suddenly, buyers step in with strong momentum, breaking above the range in a powerful move. Once the breakout happens, many traders rush to enter, expecting the market to continue higher immediately. But instead of moving straight up, price pulls back to retest the broken resistance as new support. At the retest level, price starts to slow down, and traders are watching closely. Some expect a deeper pullback, while others are unsure if the breakout will hold. Then, suddenly, an inside bar forms. This is the market pausing, creating a moment of compression before the next move. Inside bars signal that price is temporarily consolidating as buyers and sellers battle for control. If price breaks above the inside bar's high, it signals that buyers are taking charge and the breakout is likely to continue. You can place your buy order when price breaks above the inside bar's high. This confirms that buyers are in control. Set your stop loss just below the inside bar to protect against false breakouts. If price drops below this level, the setup is no longer valid. Aim for the next key resistance level where price is likely to slow down or reverse. Now that we've covered trading the break and retest strategy with the trend, it's time to focus on how to spot and trade reversals, catching the beginning of a new market move. Let's start with the double top pattern. A double top is one of the most reliable reversal patterns for spotting the end of an uptrend and the beginning of a new downtrend. It forms when price fails to break above a key resistance level twice, signaling that buyers are losing control. Let's break it down step by step. First peak. Buyers push price higher, but resistance holds, causing a temporary pullback. This pullback often finds support at a key level where some traders look for new buy entries. Second peak. Buyers attempt another push, but this time they fail to break the first peak. This signals buyer exhaustion. There's no more demand to drive price higher. As sellers step in, price drops back to the support level, which is known as the neckline. A break below this level confirms the reversal, as buyers are now trapped and forced to exit. After the breakdown, price often pulls back to retest the neckline. This is where smart traders look for confirmation that support has turned into new resistance, providing the best sell entry. Let me show you a real chart example. As you can see, the market has been in an uptrend, with buyers clearly in control. But at this level, price failed to make a new higher high and instead pulled back, forming the first top. After this retracement, price moved back up but couldn't break higher, leading to the formation of the second top. This is the double top pattern, a clear sign that buyers are struggling to keep driving the market upwards. The first top forms as buyers push price higher, but it faces resistance and retraces back down. The second top forms when price makes another attempt to break higher, but fails again to surpass the first top. The neckline is created by connecting the lows between the two peaks. This support level is crucial because when price breaks below it, we have confirmation of a potential trend reversal. After the neckline break, many traders may be tempted to enter immediately, thinking the trend reversal is confirmed. However, entering right after the breakdown can be risky. Why? You might get trapped in a false breakout or profit-taking traps where the market quickly reverts back into the range. Instead, wait for a retest of the neckline, but keep in mind, sometimes the retest doesn't happen, and that's okay. We only take high probability trades, and those setups appear only when the right conditions are in place. As we can see in this chart, the market retraced back to the neckline, and a nice pin bar candlestick formed at this key level. This pin bar is a strong rejection signal that price is respecting the broken support and is likely to continue downward. Now it's your time to enter. Place your entry after the pin bar closes above its high. Set your stop loss just above the upper wick. Use the next level as a target. As you can see, after the retest and the rejection at the neckline, the market moved down, confirming that the trend has shifted and we've caught the beginning of a new downtrend. Just like the double top, the double bottom pattern signals a potential trend reversal, but in the opposite direction. Instead of signaling the end of an uptrend, the double bottom marks the end of a downtrend and the potential start of a new uptrend. As you can see, the market has been in a downtrend with sellers in control, but at this level, price reaches a strong low and instead of continuing downward, it pulls back. This is where the first bottom forms. After the pullback, the market attempts to move lower again, but this time sellers fail to break below the first bottom, creating the second bottom. This signals that sellers are losing strength while buyers start stepping in, an early sign of a potential trend reversal. Now we have two bottoms formed at similar price levels and a neckline created by connecting the highs between the two bottoms. The neckline acts as resistance, which buyers will try to break. As you can see, the market broke above the neckline. This is the confirmation we need that the downtrend has ended and that a new uptrend may begin. Now you shouldn't enter immediately after the neckline break because there is a risk of getting trapped in a false breakout. As we discussed earlier, waiting for the retest is the smart move. In this case, after the breakout, the market retraced back to the neckline and formed a pin bar rejection candle, confirming that the previous resistance is now acting as new support. At this point, it's your time to enter. You place your buy order, set your stop loss, and target the next key resistance level where the market might slow down. As you can see, after the retest and rejection at the neckline, the market went up, confirming the trend reversal and showing that the double bottom pattern successfully signaled the beginning of a new uptrend. Like I mentioned earlier, always start with top-down analysis. Without it, you risk trading against the trend, which can lead to losing trades. Checking the higher time frame helps confirm the market direction and increases your chances of a successful setup. If you found this helpful, don't forget to like the video and subscribe for more trading insights. Feel free to ask any questions in the comments and check out my other videos to expand your trading knowledge. Thanks for watching, and I'll see you in the next one.